I'm looking at the futures right now. That's why I was glancing at my phone, and it's shocking. You have silver futures at $47.30, up fairly significantly today, and gold futures up $50 to $38.58. So we're seeing a continual movement in the price of metals that is exhibiting strength that I'm really not used to. Then again, I mean, it's moving at a clip that just seems to be defying gravity. And now I don't expect it to be that way continually, but I think what it is showing is that we're seeing a lot of big money now start to move into the space. You can see that through the massive numbers in the ETF space, where we're seeing huge amount of volume go into the ETFs. This is institutional money, if I had to guess, waking up to the reality, talking to their clients about purchasing metals. But it goes beyond that. You know, we talked about the chief investment officer of Morgan Stanley shifting his allocation model to 60-20-20, where it was 60% stocks, 20% bonds, 20% gold, breaking free from the 60-40 model that has been out there forever. But now it's going deeper than that. And now you see Bank of America, Michael Hartnett, who is talking about a 25-25-25-25 portfolio, where the strategy is 25% stocks, 25% bonds, 25% treasury bills, those are the short term, and 25% gold. And he talks about how that strategy is up 16% year to date, whereas the plain vanilla 60-40 is up only 10%, yet gold is up almost 50. Just goes to show. You got a guy named Chris Wood, I think is his name, Chris Wood, the global head of equity strategy at Jefferies. Jefferies Beige was the name of it before, or Jefferies Beige. It used to be Prudential Beige, and Jefferies bought the Prudentials, who nominated Miles Franklin to be an authorized reseller of U.S. Mint product many years ago. So, you know, Jefferies took over for Beige and then got out of the gold business. Evidently, they didn't believe it was the path for them to take, yet now their head of equity strategy is talking about gold getting as high as $6,600 here in the near term. And so we are beginning to see a lot of people talk about this. You have Jeffrey Gundlach, I believe is his name, and he's, if I'm not mistaken, a trader for BlackRock, talking about, again, people need to add gold to their portfolio, breaking free from this 60-40 split. And I guess when you see players at this level start to talk about it, certainly we should take notice. I also found it interesting, Michael Oliver talking about metal. Michael is a frequent visitor to your show, and he was talking about the lid coming all the way off is what the MSA is what they're predicting, his moving averages or his momentum averages. Momentum indicator, and he says that over the next several months and into Q1 of next year, that his momentum indicators are seeing silver as high as $100 to $200, and he says that they expect such. He also talks about not being fooled by any sharp drop that we see. He looks back to the way the markets reacted before previous bull markets, and he says they fully expect to see a corrective jolt at some point, but it's part of the current upward progress, and so not to be fooled by it. I found that to be interesting. And he talked also about gold, which has broken through a 12-year-old gradual uptrend channel. Again, technical analysis, but basically saying that he thinks that this month is poised to produce a new high peak monthly close on annual momentum. There's only a few days left in the month. Again, these are all very, very, very bullish things for the price of gold. And I just think that people in this country have yet to recognize that gold is rising, and rising against all of the G7 currencies. But it's not about gold. It's about loss of purchasing power in all of these currencies. And all of these currencies are now basket cases. So yeah, I think that, wait until China really starts to turn up the heat and starts to dump treasuries at a faster clip. I think maybe that's why we're seeing all the gold come back and the talk of tying gold to a new monetary system, because in my mind, as much trouble as China is having, their yuan gets saved by gold, and the dollar without gold to back it, it goes down. And maybe that's why we're seeing all of this gold come back, to have it tied to a new system. I'm not really sure, but when we see China building vaults all throughout the global south, starting with Hong Kong and then Saudi Arabia, you'll have the vaults in St. Petersburg, of course in Shanghai, in Singapore, Dubai. These will all be connected and tied to this gold vaulting system, where nations' golds are held in vaults in their own countries. And I think that'll be ultimately trusted much more than what we see in New York and in London. Jeffrey Gundlach, they call him, that just came to me, call him the bond king. And he is saying that it's time to move away from traditional 60-40 split. This is a guy who in essence, it's like the casino betting against their own game, speaking out against their own game. He's saying that you'll see gold at 4,000 by year end. And he talks about that your savings account is bleeding out, at least at 4% per year, but actually, it's probably a lot more than that. They talk about a money supply that has increased by as much as 7% per year. You see M2 again racing higher right now. So as we see money creation running at such a level, your $10,000 right now after an 11% drop is worth $8,900. And so if you're buying treasury bonds paying 4%, that's $400 a year on your $10,000. The IRS is going to take $100 of that right off the top of your $400 profit. But when you look at the debasement of the currency, you're negative between taxes, where if you're buying bonds and it's like the government is taxing you for lending them money, which is really stupid. But between the monetary dilution of money supply growing at between 7 and 10% annually, the dollar down 11% now, the taxes on top of all of this, it's a losing game. It's no wonder that they don't say this.
I was glancing down at my phone earlier, watching the futures, and I had to shake my head. Silver futures pushing above $47. Gold futures up $50 on the day to $3,858. This kind of strength is something we're really not used to in this space. Metals that have spent decades suppressed, capped, ridiculed, ignored. Now moving like they're breaking free of gravity. And look, I don't expect it to be a straight line. We'll get corrections. We'll get those sharp drops that try to shake you out. But what's important is that the big money has arrived. You can see it clear as day in the ETF flows. The volumes are massive. This isn't your cousin putting $5,000 into a silver ETF. This is institutional. This is pension funds, sovereign wealth, endowments, the kinds of investors who can move billions with one allocation shift. And when that kind of money decides that gold and silver belong in the portfolio, you get moves like this. For decades, Wall Street mocked the metal trade. They sold you the 60-40 model, 60% equities, 40% bonds, as if it was handed down on stone tablets from Mount Sinai. And for a long time, maybe it worked. Stocks went up, bonds paid you 6%, 7%, 8%. But the world changed. Rates went to zero. Bonds became guaranteed losers. Stocks became casino chips propped up by Fed liquidity. And for the first time in my career, I'm seeing Wall Street itself break the 60-40 taboo. Morgan Stanley's CIO floated a 60-20-20 model. 60% stocks, 20% bonds, 20% gold. That's a huge deal. If a $3 trillion asset manager tells its clients to put 1/5 of their wealth into gold, do you understand the tidal wave of capital that represents? And then Bank of America's Michael Hartnett went further. He laid out a 25-25, 25-25 portfolio. Stocks, bonds, T-bills, gold. That's Wall Street openly admitting that gold is no longer a hedge. It's a core asset. And he showed the math. That portfolio is up 16% year to date versus the plain vanilla 60-40 up only 10%. Gold, up almost 50%, has carried the load. You think pension funds, which are desperate for returns, aren't paying attention? They are. Chris Wood, global head of equity strategy at Jefferies, came out this month talking about gold hitting $6,600 in the near term. Let that sink in. A Wall Street strategist at a major house is openly publishing targets that sound like gold bug fantasy. Jeffrey Gundlach, the bond king himself, is on record saying it's time to dump the old 60-40 and pile into gold. He's forecasting $4,000 by year end. When the casino owners start betting against their own game, you'd better notice. And this isn't just talk. China is building vaults across the global south. Hong Kong, Shanghai, Singapore, Dubai, Saudi Arabia, St. Petersburg. They're not just buying gold. They're building the infrastructure to control global settlement in gold. Think about that. Nations holding their bullion in their own vaults instead of trusting London or New York. That's a tectonic shift in confidence. It's about trust. Who do you trust more? Your own vault or a paper claim sitting at the Bank of England? Meanwhile, guys like Michael Oliver, someone I deeply respect, are putting out technical research saying the lid is blowing off. His momentum indicators project silver between $100 and $200 in the next several months into the first quarter of next year. And he warns, don't be fooled by the corrective jolts. They're part of the move. He's right. In every great bull market, you get violent shakeouts. If you let them scare you, you miss the move. And Oliver's not just saying silver. He points to gold breaking out of a 12-year channel, poised to produce a new all-time monthly close. That's historic. And it's not just about gold rising in dollar terms. Gold is rising against every G7 currency. The euro, the yen, the pound, they're all basket cases. This isn't a US story. It's global debasement. Think about Gundlach's other point. He said your savings account is bleeding at least 4% a year in real terms. The money supply is running at 7% to 10% growth annually. M2 is racing higher. Inflation, if you measure it honestly, is double digits. So that $10,000 in the bank? After an 11% drop in purchasing power, it's really worth $8,900. And if you buy treasuries at 4%, the IRS takes a quarter of that, and you're still negative after inflation. Lending money to the government right now is like paying a tax for the privilege. I like how a meme I saw put it, you buy treasuries, you get taxed twice. Once by the IRS, once by inflation. Meanwhile, gold is up 40% this year, silver 50%. Who's the sucker? And here's the irony. These same banks telling you for years, don't buy gold, are now publishing reports saying gold should be 20% of your portfolio. Chris Wood saying $6,600. Bank of America saying gold outperforms 60-40. Gundlach saying $4,000 by year end. The hypocrisy is almost funny. They trash it for decades, then quietly start allocating billions. And by the time the public catches on, the price will be multiples higher. Now, I don't want to paint it as risk-free. We're going to get volatility. We're going to get scary drops, but don't confuse volatility with risk. The real risk is holding an asset guaranteed to lose purchasing power. Dollars. Treasuries. That's risk. Volatility in something that's preserving and growing wealth. That's opportunity. What really matters here is that the narrative is shifting. For decades, gold and silver were fringe. Now, mainstream Wall Street voices are saying, gold is core. And when that happens, the allocations shift. Pension funds, insurance companies, sovereign wealth, they all rebalance. If global allocation to gold and gold equities is 0.5% today, and the long-term mean is 2%, a reversion to mean is a fourfold increase in demand. Imagine what happens if we go beyond that. Imagine what happens if we hit 5%. That's the setup. That's why these moves feel like gravity is breaking. It's not retail. It's not hype. It's the biggest money in the world quietly repositioning before the public wakes up. And when the public does wake up, when CNBC is running, How to buy silver miners segments when your neighbor is bragging about his junior mining stock. That's when you'll know the mania has arrived. But we're not there yet. We're still early.